for the introduction. First of all, I'd like to confirm that you can see some part of my screen, and hopefully it's showing a slide that says, "Are you making money?" All right, I see a thumbs up for that. And that's a nice segue. I encourage you to use the hand raising or use the chat. Now, I will tell you, normally we do this seminar with my cohort, Casey Adams. Unfortunately, she wasn't able to join us today. This session is being recorded, as I understand it, and we will be able to capture any questions that you have that I don't address proactively, and we'll respond to you afterwards. As part of the presentation, you'll also be receiving a workbook, and I think that that'll be made available to you in the chat. And that workbook has, we'll actually reference that workbook, but it's intended to help you with an example of how to put things in various places. So I hope that you guys will have that. And then in addition, I know that Kim Young has distributed the one pager that is like a cheat sheet. We call it a tip sheet with some key terms on it and some key ratios on there that we'll talk today. So again, my name is Carrie Cabak, and I encourage you to ask questions about any of the conversation that we have today. And if we don't address it directly, we will get back to you. So we're going to talk about making money, and we're talking specifically about your business making money and how important it is to understand what the three primary financial statements are that help answer that question. The purpose that we have here today is to empower, excuse me, I was going to try and minimize, there we go, so that you can see more of the slide. Our purpose today is to empower business owners to understand the various financial indicators that are needed to drive data-driven decision making. Obviously, we are asked a lot, as business owners, we are asked a lot of questions about how well our business is doing, primarily from people who we are either trying to buy something from or we are trying to ask for money. So in effect, we're buying money. But what we really want business owners to feel good about is being able to know how to get the information and where to get that information in answering those questions. When you leave this workshop today, we really hope that you will understand three key things. The first is how the key financial statements support your ability to answer that question. We want you to know which statement is which based on its structure. The three primary financial statements all have key structures that you should be able to identify just by looking at a financial statement which one it is. And then I also want to focus your eyes on particular numbers, or what we like to say, key indicators in those financial statements that will help you to answer these questions. I've included in the slides that you'll have a little bit about my background. If you're interested in a full curricula vitae or resume, I'm happy to get that to you. But I will just tell you that what motivates me on a daily basis is being able to help business owners build their dreams, and to do that by understanding how to get the most out of their business. And so I just dig it, and I'm really happy that you guys are here today, and I'm hopeful that there'll be some information here that you can utilize. But if you have any questions, this is who I am, and you are welcome to reach out to me with any follow-up if you like. So just a couple things. We really do want you to ask questions, but we have a limited amount of time today. So please use the chat, and I'll monitor that periodically to see if we're hitting, actually, I'm not sure if I can actually see the full chat, but I'll monitor that to ensure that if you do have any questions, that we are getting those addressed. As I mentioned, the workshop is being recorded, and hopefully you will be receiving the slides and handouts. And let me just check the chat really quickly because I want to make sure that you guys have that.
They are in the chat, so if you're able to open those, you should be able just to click on them and pull those up.
Good, thank you. Thank you so much for confirming that. That's totally cool.
Yeah,
all right.
Sorry, a copy of them has also been emailed out. So if you aren't able to do that, they should be in your email.
Way cool. All right. So what we're going to cover is we really want to address that fundamental question, or the fundamental answers to those key questions, which is, how much is my business worth, and is my business making money? And believe it or not, those are two totally different questions. A lot of times they get combined in conversation, but financially, from an accounting perspective and from a financial and analyst perspective, they're two very different questions. Believe it or not, your company can be worth a whole lot and not making very much money. And you could be making a lot of money and your company's not worth a whole lot. And what we will not cover today is we will not cover the effect of blue sky. If you're interested in blue sky, this is the non-tangible value that your business offers to the world. And I'd love to talk to you more about it, because it is the essence of what we've probably worked so hard to create in our business. And it's not often, well, it's impossible to put a number value on it. But it's important that we identify it and promote it if we are trying to promote our business for the purpose of potentially merging with another business owner to create a bigger business, or if you were selling your business. So blue sky is really important, but we will not go into that today. I've written a blog about that on the Archimedes blog if anyone's interested, and let me know and I can get that to you. But in order to answer those questions, we're going to look at these three financial statements. And for each one of those, in addition to structure, we're going to talk about some terminology. If there's anything else that you'd like to cover in the future, please put it in the chat so we can capture it. And we'll have an opportunity for you to take a survey if you want and provide that information to us. So we have to start with those two essential questions. As I mentioned, how much is my business worth? And is my business making money? And it's really, really interesting that in the 30 years or so that I have been in a position to help companies make database or data-driven decisions, that I am surprised how many folks really aren't using, let alone using appropriately, the financial instruments that are available to them in order to at least become more informed. I would never base a decision solely on the information in a financial statement. And that's one of the recommendations I have for all of you is this is not a panacea. Don't build an expectation that your bottom line answer is going to be in this documentation, but it's an important part of the answer. So don't worry if nobody understands your financial statements but you, and that's okay, because maybe you're the only one that needs to understand them. And that's a good thing as well. The way we answer both of those questions are with ratios. And the three most useful ratios for these particular questions are presented here as your debt to assets ratio, your asset turnover ratio, and your net profit margin ratio. Each of these ratios is calculated with a formula that you will get the information for the top or the bottom of the formula directly from the financial statements that we're going to look at. The key variables in these formulas include your total liabilities, and we'll talk about the definition of that, but that is your obligations to pay, your total assets, or the things that you own. Sometimes it's cash, sometimes it's equipment. Total revenue, which, believe it or not, is different than total income. That's why we differentiate total revenue in this formula from net income in the formula below. Your average total assets, which is a collection of assets, or is a number derived from looking at your assets over time. Your net income, which we're going to define, I promise you, divided by the total revenue, which we just talked about. And yes, I promise you we're going to cover these guys here in very short order. What's key, and if you were to take one thing away from this workshop today, what I'd hope that you could focus on is using these three ratios to evaluate your financial position. With the debt to assets ratio, the higher that number is, it means your company is facing greater financial risk. It means that the amount that you owe is substantially greater than the amount that you own. And we'll talk about how that could be, especially if those of you are familiar with the balance sheet. We always think, well, balance means my assets needs to meet my liabilities. But in this case, we are eliminating a key portion of the liabilities from this formula. The asset turnover ratio and the net profit margin ratio work in the opposite direction. The bigger or higher the ratio is, the more efficient or better performing your organization is. These are the offset ratios to the debt to asset ratio. And I really encourage all business owners to look at things from many sides. Don't always just look at positive indicators. Look at what they call reverse indicators. A debt to assets ratio is a reverse indicator. So I present these here for you to play with as we go through some of the exercises. And if you have any questions with them, of course, don't hesitate to ask. The source of those variables that we just discussed come from these three financial statements. The first is the profit and loss statement. And we refer to that affectionately as how much money has my company made and how am I using it? Those are primarily the questions that it answers. The balance sheet is the second key financial statement, and it summarizes what do I own and what do I owe, or what we refer to as obligations. The cash flow statement, the third and equally important statement, tells us how much cash do I need right now. And that's the one that a lot of small business owners are more focused on, because we know that our bills are coming due immediately, and we want to make sure we can cover our obligations, our short-term obligations. A lot of people ask me, how is it possible that I can be making money but not have enough cash at any point in time? And that is because of timing. And another thing we won't go into great detail on today is timing. But the timing of your income and the timing of your obligations can directly affect the size of your cash flow statement, or the cash flow that you have on a periodic basis. So let's look at the profit and loss statement. A couple key points about that. It tells you the overall performance over a period of time. So it's looking at the fact that if I ran my profit and loss statement from the first of the month to the last day of the month, I can see within that month period how I did. How much revenue did I have? How much total income did I have? And how big were my expenses? And what was my net income or profit at the end of the day? This statement is what generates the old colloquial statement, your bottom line. And while the bottom line is not sufficient for telling you what your company is worth, it certainly can tell you whether your company made money. So this is the key value of the profit and loss statement. And I really believe that this statement, especially if you look at it over a longer period of time, can give you a really good picture about the overall health of your business's ability to make money. Some of those terms that we talked about a minute ago, I want to dig a little bit deeper. In order for you to have a good profit and loss statement, you need to have some very specific components in your accounting system. And we will talk about an accounting system in general terms. Please note, I am not suggesting that it's anything sophisticated. I have seen beautiful accounting systems with 3x5 cards, and I'm not kidding you. Beautiful accounting systems where they're tracking their general ledger transactions with colored 3x5 cards so that they could keep track of the different accounts that they wanted to track for financial purposes. So the chart of accounts is that organizational tool that allows you to track all those transactions in specific subcategories that are important to you. Transactions are those activities. It's the purchasing activity. the invoicing activity, a charge card activity. These are all transactions. Revenue is income from the sales of your product or services. And this is important because when we talk about ratios, we compare the health of your business's ability to make money based on its total revenue. Whereas you may have other income sources, in the best example, where perhaps you own a building, your business owns a building, and it sublets a part of that building to a small company, potentially a partner, but they're paying you rent. In that case, that rent is income, but it is not revenue from your primary products and services. And the reason this is important is that if you're evaluating the performance of your business, you want to evaluate it based on its ability to produce sellable products and services. So hopefully that helps you differentiate between revenue and income. Within the income bracket, we talk about gross income, which is the total income from all sources before we deduct any expenses. And there are a bunch of expenses that we're going to talk about deducting. The net income is what you get when you subtract all those expenses from your gross income. And again, on your financial statement, we will show both revenue and income activity, and you will calculate both gross and net income results. Fortunately, making it easy, profit is the same as net income. So we'll put that aside. And you may have a question, well, gosh, Carrie, if I'm only interested in my business performance from a revenue perspective, why do I use net income rather than revenue in my profit calculations? And that's a really important question. We don't have a lot of time to go into today, but the bottom line is that those ratios actually differentiate out revenue from income. And this is why the ratios are really important. That's key to answering that question, how valuable is my business, or how much is my business worth? Expenses are those costs. They are the result of a transaction. So an expense is a direct use of cash. It's a real use of cash. It is not like depreciation and amortization, which we will address in a minute. It is an actual handoff of cash from you to another party. So that is everything from your payroll to your income taxes, utilities, etc. And then finally, the general ledger. And the general ledger is that record of each financial transaction. So together with the chart of accounts, the general ledger and the chart of accounts are the backbone of your accounting system. And these can be done on paper with 3x5 cards in Microsoft Excel or with online tools such as QuickBooks. There's all sorts of options there. The profit and loss statement is structured in two chunks. The income is always on top, and the expenses are always on the bottom. So let me pull up, let me get that. I wanted to bring up the workbook that you have. And if you will look in your workbook on page 1, the workbook is a profit and loss statement. So let me pull that up. And if somebody could give me a thumbs up that you can see this profit and loss statement, I'd appreciate it. All right, I'm thinking no thumbs up, so maybe you can't see that. Let me stop sharing and see if, okay, thank you, Alana. Let me stop sharing and try to share and see if I can share my screen. Let's see if this will work. We're going to give it a shot. Please let me know if you can see the profit and loss statement now. I'm not seeing any thumbs up. Oh, good. Okay, wonderful. Thank you very much. So as I mentioned, the profit and loss statement is structured with your income accounts on top. And these are all fictional. I just put some numbers in here for you to play with. And I was being optimistic. I always like to see big numbers as an accountant. But you basically indicate your sources of revenue. And in this case, I didn't make it complicated. I just simplified all of this to income. But technically, these products sold and services sold are revenue. And in this case, there were no other sources of income. And you will see that oftentimes those two are collapsed where the entity or your business has no other source of income. In the expenses section, again, just hypothetical numbers. I organize this and I recommend that you organize your expenses according to your business or natural flow of operations. So in this fictional case, they do some marketing and sales up front. So they've organized an account that they are calling promotion with a few sub-accounts. For those of you that have products, I strongly encourage, if you're not already doing this, to organize the cost of producing those products under a cost of goods and services sold. And again, we could talk about that more later if anyone's interested. Separate out your overhead. And there are a lot of philosophies on here with regard to which overhead applies to that labor, particularly with benefits. And there are several strategies with that. And we can't cover that today, but if you are interested in that, that is something I work on quite a bit. And then I did put as a separate section some financing activity here on the assumption that this fictional company had some loan payments that they needed to make in the last year. And they also paid some additional interest. So this example is just showing you how it's covered. The second sheet that we need to cover is the balance sheet. And with regard to the balance sheet, we've already talked about the fact that it accounts for all of those things you own and all of those things that you owe or are obligated to pay. The important part about the balance sheet is, unlike the profit and loss statement, which looks at your performance over a period of time, the balance sheet is really only as good as the day that you run it. You pick the date that you want the performance to be. So it's a picture or a snapshot. If you think of the profit and loss as a summary, as a movie, the balance sheet is a snapshot. And it's really looking at how things are at a point in time. Key terminology on here, we've touched a little bit already on assets, which are things such as cash or cash equivalents or property that has value and is owned, versus liabilities, which are your obligations to pay out. And depending on if you are using a cash basis or accrual basis form of accounting, these numbers can be slightly different. Two other areas that are really important on the balance sheet are owner equity and retained earnings. And as business owners, these are the two that you are probably most interested in, because the owner equity is describing in dollars the amount of value that you hold as the owner or as a shareholder to your business. This is the amount that the IRS uses to determine when you have to pay capital gains, for example. The retained earnings area looks at the cumulative earnings of the company throughout its lifetime, minus any dividends or distributions that are paid to the owners or stockholders. And I did put a little note in here because again, there's a lot more here than we can cover in our time, but the larger retained earnings reflects your company's ability to invest in your growth. Again, I'm a huge promoter for growth, and I don't mean get big. I mean stable, healthy, steady growth as a business. And if the business owner or owners decide they want to grow to become a big, large organization, this is what helps you do it. So if that's your goal, if your goal is to grow, you want to focus on getting your retained earnings up there. The structure to the balance sheet is pretty straightforward. The assets are on top. Again, I really love it that the accountants had the wherewithal years ago to think positive on top, followed by obligations or liabilities on the bottom. And we have current, and typically current, you'll see some changes, or you'll see variation in the definition of current. In some businesses, they'll say it's 1 year. In others, it's typically anything less than 3 years. The key is that you identify it and that whoever's doing your book stays consistent with it. And then you have long-term, and that's the same. And these terms for current and long-term under assets and liabilities are the same. Long-term are those assets that typically we appreciate or depreciate, and that's why they're referred to as long-term. Another example of a long-term asset would be a bond or a CD that you've invested in, but typically we would report that under our investment section. And our liabilities, we would have our shareholder equity, as we talked a minute ago, and retained earnings. And for example of that, if we turn to the workbook, your second page in the workbook is a sample balance sheet. And this is a comparative balance sheet. I stipulated this was accrual basis just to give you an idea of what this might look like. But basically you can see here that you have some current assets on the top. There is some inventory. Inventory is an interesting topic, but I'll just say, if you want to know more about inventory, let me know. But inventory may or may not be current assets. So in this fictional example, I've included it as a current asset, but depending on what it is, it may not be. And then under the fixed assets, we have some land and equipment in this business. And at the end of the day, they have about $900,000 in assets. On the lower half of the balance sheet, we see all the liabilities. And again, the level of detail here depends on how you've structured your chart of accounts. I don't have any easy rules of thumb for structuring your chart of accounts, but what I do encourage is that you get the picture laid out here so you're comfortable with it, and you should be able to defend every single item on here and every amount. You should know, you don't need to know the amount, you need to know where the amount originated. You'll also see at the bottom, there's owner's equity and retained earnings. The last statement that we'll talk about is the cash flow statement. And this identifies where the cash came from during the period of interest. You can run this for a month, a quarter, a year. And the key thing is we want to use our past data to help us determine our forward picture. And we want to make sure we have enough cash to pay our bills today, but also to plan for the next future period. A key thing to the cash flow statement is it should be positive. Some key terminology, meaning it should be a positive number. Key terminology in the cash flow statement, which you'll see reflected also in its structure, are these words here: operating activities. Those are pretty much the things that we do every day to operate our business. And this is typically the cash that we receive or we pay for all of the work that we do to keep our business running. The investing activities and the financing activities are two other areas on the cash flow statement that are really beneficial if your company is performing those types of activities. So in the investing activities, believe it or not, if you buy a large piece of equipment, you're actually investing in your equipment unless you're paying for it all cash today. So if you are depreciating something, it will almost always show up under your investing activities. Your financing activities include those activities where your owners may want to put more money into the company, or you're paying out a dividend or a distribution to the owners. So the financing activity represents something that every small business will have if they have an owner, which they do. And it tells us where our cash position is. For example, if the owners have agreed that they want a dividend at the end of the third quarter, then this section would show that if you ran the cash flow statement for that period that included that quarter. I talked about depreciation and amortization earlier. The important thing about these terms is that they actually don't represent real money. However, you've already taken into account the benefit of depreciation or amortization when you calculated the profit and loss statement. So therefore, with a cash flow statement, if we've recorded depreciation or amortization of a loan, we actually have to add it back in because we actually really didn't spend that cash. And that is an important part of structuring the cash flow statement correctly. The structure is pretty straightforward. You build it from your profit and loss statement, your balance sheet, and of course your general ledger, which is that record of all your cash transactions. There are two different methods. They have value of each of them. There's no bias here. There's a different reason for doing one versus the other. And we always organize it in the same method: the operating activities, investing activities, and financing. And the rule of thumb on the cash flow statement is that it's actually organized in the order of urgency in using your cash. So on the third page of your workbook, if you think about the fact that we have operating activities, these are the types of things that we have to do every month or every week or however. And you'll see I just put 1 month of information in here. But these are really urgent. We have to pay our bills. We have to spend this cash. Investing is typically the next slowest. Let's see, I use fastest. So operating activities are the more immediate needs. Investing are the next urgency, and financing is typically the least significant because, as you all know, as business owners, if something happens upstream here, you may not get that dividend or distribution that you were hoping for. So just in summarizing as we close in here, I talked a little bit ago about an accounting system, and I really want to point you to getting a tool. If you don't have something you like, there are a lot of different solutions. You know, in this day and age, most tools are going to Microsoft Excel, but I will tell you, there are some dual entry accounting notebooks that I still love and use just to double check what I'm thinking. It's a wonderful tool for a logic check, and there is some logic that goes into accounting. But if you like Microsoft Excel, all of these tools can be, in fact, the notebook was derived right, I built it right in Microsoft Excel, so you can just copy that into Excel. And then of course you have tools like QuickBooks or QuickBooks Online. The key is you've got to have an accounting system of some form. The other thing you want to think about is your transaction history. So please don't be throwing away those invoices. They really are important. Same thing with the receipts of your transactions and credit card statements. An upcoming seminar in this same series is talking about record keeping. And in that seminar, in that workshop, number 4 out of 6, Casey Adams, my cohort, is going to talk about the importance of records and how long you should keep them. And it might surprise you that some things need to be kept way longer than others, and for good reason. And then finally, the last thing that's really important, and this is part of your accounting system, but the reason I separate it out is having a really good chart of accounts that you understand and that you love is really going to make this whole process easier. And it takes time to set up a really good chart of accounts. Don't just assume that a default chart of accounts is going to work for you. So what? We know as business owners that we've got to understand what our company's value is, what we're worth, because it helps us to decide whether or not we're going to invest further, whether or not we're going to need a loan, whether or not we want to take on partners. We have learned through this workshop that the use of ratios can help us, but the use of ratios depends on our use of those 3 key financial reports. And what's key in those financial reports is that we understand some basic terminology and structure so we can point to the key values in our financial report that will help us go back and calculate ratios. If you would like to have any more in-depth review, please reach out to Soretti. They know how to get us, and I cannot tell you how much we love this organization. We are new to this area, and we're so excited to be helping in Southern Oregon. And Soretti is doing a fabulous job of getting people connected. So don't hesitate to reach out. And of course, you can find us on our website. And I did put, now in your surveys, in your slides, there is a PDF of this slide. If you are interested, if you'd like to take the survey, I am happy. You should be able to hover over it like I'm doing, and you should be able to click on it. But if for some reason, because I made it an active link, but if for some reason it doesn't, I'm happy to send out this survey for any of you. At that point, I think we're done.
Great. Thank you, Carrie.